So you mentioned earlier just kind of the behavior of, I guess, retail buyers of physical gold and silver. One of the narratives is like, oh, there was a lot of speculation. One of the narratives is that because gold didn't run up leading to the Iran war and sold off afterward. The other narrative was that countries needed to get liquid and such. And then you have these other narratives about gold no longer being a safe haven, blah, 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 right? So I'm just curious, what are you seeing with retail behavior? I mean, because you all at Miles Franklin deal with a lot of people that, want to protect their wealth and such. And so what are you all seeing with retail
first of
behavior?
all, before I get there, that narrative, again, is just stupid. I mean, and that's what they want us to believe, right? And that rates are going higher, so that's bad for gold. Well, how about the fact that for 2-3 years after COVID, rates went higher faster than any time in history, from like 0 to 4+ in a period of like a year, and gold still went to the moon and tripled since then. Here we are since it was 0 in 2021 or whatever, to where we are now, from like 1,700 to almost 5,000 in rising rates. Convenient to ignore that by the mainstream when it's happening. And yeah, they want us to believe that, but if that were the truth, then why are we seeing record deliveries every single month? Why in the month of February did China import more silver than in the history of all recorded markets going into China ever? The month that it got destroyed. Why are we seeing these deliveries in every single month on COMEX? So far in April, 18,647 gold contracts at 100 ounces apiece. It's almost $1 billion. And 1,753 silver contracts at 5,000 ounces apiece. So let's do the math there. 1,753 times 5,000 is 8,765,000 ounces. And let's multiply that times... oh gosh, silver's up almost $4 right now. It's at 79.20. So let's multiply that times 79. That's $692 million worth of silver have been delivered so far in the first week or so.
$1 billion or
yeah.
$1 million? Yeah.
692,435,000. Okay. But by the end of the month, because that's only for the first, what's the date today? It's for the first 2 weeks. By the end of the month, we'll be way over $1 billion. And it's been way over $1 billion every single month. In February, which is a non-delivery month, 25 million ounces delivered, 39 million ounces leave COMEX. 160% of what was delivered left. 2 million pounds of silver left. Billions of dollars worth left. Who's running logistics? Where are the trucks coming from? Who's doing that? Where's it going? Who's paying for it? 2 million ounces leave the eligible category a few Fridays ago. Those aren't even the bars that are available for sale because no one trusts the system anymore. The narrative that war pushes up the price of oil, which pushes up the CPI, which pushes up inflation, which then makes no rate cuts. Well, that's bad for gold. Well, again, if people trusted the dollar and the treasury, it would be, but they don't. This is the MOPE, Management of Perception Economics, that my dear departed friend Jim Sinclair used to say. We knock the price down to control the narrative and then stand for delivery because we don't use margin. They knocked off all the speculators, freaked everybody out, and then you see every single month, even in the month of February when the price got hammered, huge deliveries here on COMEX and actually leaving the exchange, the largest silver deliveries in the history of recorded markets in China that month. And I'm telling you, the central banks haven't stopped, and nor have the deliveries on COMEX every month for 18 months. That betrays all of the mainstream narrative, which is still using...
They saw it as a bargain.
That's right. Let's shake them from the trees. We'll jack up the margin rates. Even the IMF came out and said, it was either the IMF or the BIS, that this was not a fundamental decline. It was structural, largely blamed on rebalancing of levered ETFs and margin increases. They said it is not fundamental. It's structural. In other words, it was engineered. Jack margin rates up and rebalance the ETFs that were way out of whack because of silver's rise, and bang, create selling, beget selling, beget selling, get margin call, I'm out. And it destroyed all of for the refining in this country. The refiners had to bail and say, we can take no new business. They were getting margin called every day. So the structural, engineered price decline fell right into the hands of the big traders. That would be the sovereign wealth funds, the governments, including the United States, in my opinion. All of these countries that want physical possession, that don't use margin, they said, thank you, we'll stand for delivery, bye-bye, at wickedly subsidized prices because of the leverage unwind, which, according to the highest, most powerful banks on the planet, was structural, not fundamental. So yeah, it's just a bunch of phooey that the mainstream media, which lacks any integrity or journalistic work effort or work ethic, they just sidestep.
Yeah, so like with retail, like we see this, even in the stock market. Like you got the market makers, the market movers, which are the big institutions that come in, sell or buy whenever there's fear and such, and then then you see retail start to like hop on the back of their coattails, when price starts to move or whatnot. I'm curious, like are you seeing more fear amongst like retail? Like, okay, yeah, we got in at these highs. Okay, now we're not, we're stepping out of this, or we're going to sell. Like, just curious on what you're seeing. So, and
that's why there's an entire school of investment theory called wave theory. Kondratiev and Elliott wave speak to the cumulative emotions of the herd. And yeah, I have seen more than I would like to admit. A lot of capitulation because they are listening to their money managers. They're listening to the mainstream media that is telling the absolute wrong thing. Again, if price was an indication of value, then why the hell are the most well-informed traders on the globe standing for delivery across the globe nonstop? They use price as a tool of misdirection. And so, yes, fear is the most powerful motivational force on the planet. And when people get scared, they act irrationally. They dump at the worst possible time, which drives down the price, which falls right into the hands of those standing for delivery who have the information and the funds. That's exactly what's happening. And yeah, even the well-informed alternative side of the table, our side, these people are not immune to the emotional. Look, I'd be lying if I said I wasn't. I've been doing this 36 years. I've lived through every downturn we've ever seen in the last 3.5 decades, and it still bums me out. But I'm at least wise enough through watching it all and understanding the deliveries and stuff to understand where this will ultimately go. But yeah, it messes with you. Like, again, it's like I'd be lying if I said otherwise. But you have to be able to separate emotion from rational, logical thought. And if you can do that, it makes the emotions worth less than emotion is important, right? Fear is important at telling you, hey, danger. But you have to try and understand, is this manufactured danger or is it organic? Is it real? And I think the manufactured danger, you can see through it if you look closely based on the deliveries across the globe, not just here, but in Shanghai and on the London Metals Exchange, et cetera. This run is not over, not even close to being over. And if it were, you would see the central banks dumping. You would see not deliveries on COMEX, you would see the COMEX being flush with metal as everyone was selling it back and getting out, not standing for delivery and taking it out.
Yeah, for sure. So when we had that big run up, a lot of people were well, I can't say a lot of people, but many people that I know were looking to sell and kind of liquidate. Silver's over $100. They were trying to sell, and there was a lot of the issues with the refineries and all of that, to where it was creating these huge like backlogs and bottlenecks and such, to where people couldn't really get out of, couldn't really get liquid, and so. Do you see that as going to be, as prices continue to go higher, do you see that as going to be a consistent issue, or do you think there's things being worked on in the background to try to alleviate some of those issues?
Yeah, I think the jacking up of margin prices created created issues that were maybe not intended. For example, the refiners don't just work with precious metals. They have integral part of the actual economy, and they all got shut down because of raising margin rates. To try to explain what I'm saying, if you're a company of our size that does a lot of business, typically you're going to hedge your exposure. Meaning if you have 2 million ounces of silver in your warehouse, you will sell 2 million on paper. If what you have in your warehouse goes up by $10 on your 2 million ounces, that's 20 million profit. It falls the exact same amount on what you sold short, and vice versa, so that you're never speculating with your inventory. You're market neutral. That's how you stay in business and don't screw yourself when the price falls by 30% like we saw in January. So in early December, let's say December 1st, I'm going to be close on these numbers, it would have cost us $15,000 approximately to hedge 5,000 ounces, one contract of silver. So we put that money in a margin account. Just sits there. It's a collateral account. Just sits there, unless the price moves against us. So 5,000 ounces, call it at $60 a piece back then, would have been $300,000 of silver I could control with $15,000 in my margin account. That's 5,000 ounces. We would typically have 2 million ounces in our warehouse. So you can see the cost is very high to hedge that. You got to have $20 million sitting in your margin account, right? Okay, fine. That's just silver. About gold and platinum. By the beginning of January, that number had gone up 300% in terms of what you needed to have in your account. So 15,000 became over 50,000 to hedge 5,000 ounces. The cost of hedging your position became so high, the cost just became, it had to filter down into lower bid prices. And if you weren't hedging, a lot of the companies don't hedge, and the price fell by 30%. When you're lucky to make 2% in this industry, you're done. You're crushed. You're probably on life support right now if you've been able to hang on because you lost so much in your inventory. So if you don't hedge, you better back your bid prices way back, because if not, and it goes against you, you are out of business. If you do hedge, your cost went up so much that the cost of doing business is such that you won't make any money unless you start to change things. Well, that spilled over into the refiners. If they have 50 million in inventory they paid for, and they're trying to break it down and turn it into shot and then melt it down and turn it into bars and rounds, that takes a period of time. You got to hedge that inventory. Well, they were getting margin called all through January as the price kept going higher and higher and higher. They had shorted the same amount that they had in inventory, which takes time to refine. So as their price of their inventory was going up, they're getting killed on their short position, and they were getting margin called. And then they kept raising rates on top of it, margin rates. The refiners are like, we can take no new business. We're going to go out of business. We're getting margin called. We're exposed. That's it. Well, the refiners are still months back ordered, and they're still hardly efficient right now. And it created a lot of problems. So I would like to hope that will work itself out in the future. I've never seen bid prices like this ever, Daryl, in 36 years, ever. We're selling pre-65 junk silver right now at $2 back a spot. We're selling it. I've never, ever did that, ever in my career. It's a crazy, crazy, crazy time. Like to the IMF or the BIS's statement that this sell-off was largely structural, raising of margins and levered ETFs unwinding and rebalancing. The unintended consequences have been pretty profound. I think someone probably got chewed out for that, and I don't think you'll see that happen again. That would be my hope.
Yeah, for sure. Okay, so many of the big banks, the big institutions, they still have these high price targets on gold for year end and looking on out and such. So are you typically in agreement with that? Do you think we're going to get a period of consolidation? I mean, we went down to what, 4,300, 4,200. Now we're back at
4,100 at the bottom.
Yeah. Now we're at like what, 48, 49.
What are we at right now? Today, gold's up about $60, 4,800, and silver's up $4.50 to roughly 79. So, yeah, I do. I mean, you got all the big players calling, a lot of them, for $6,000 or higher by the end of the year. Could it happen? Sure, why not? Typically, you would expect to see things really take off come September, October. That's usually when you see things move. But Look, the fundamentals would support it. Certainly, nothing has changed. If they're right about saying it was structural, not fundamental, nothing's changed. And all of these banks, Bank of America, you know, you got the chief investment officer of Morgan Stanley, who earlier in the year said sell half of your bonds. The 60-40 rule that's broken. BlackRock just said the 60-40 rule is broken. The chief investment officer of Morgan Stanley said that 60% stock, 40% bond is broken. Sell half your bonds and buy metals. Well, BlackRock is doing the same thing. The lead analyst for Bank of America, Michael Hartnett, said no, you should have 25% of your wealth in precious metals. Their head gold trader just came out and said that he could see silver between $130 and $309 by the end of the year. So yeah, I mean, the banks are still calling for it. The logic, if you can separate the emotion, says, yeah, it should probably already be there based upon the demand and the dollar creation and the manipulation and all of the stuff. Sure, why not? But I don't focus on price, Daryl. I look at the fact that if you hold it long enough, the bull market will take care of your entry. The bull market will push this much higher.
Yeah.
Focusing on prices is dangerous, and I think you put yourself out on a limb, but I would say prices will go higher than people think possible.